Mike, we've had a series of calls, 3,000 from JP Morgan, Evercore, Oppenheimer. When this gets signed, sealed, delivered, am I going to see more calls for 3,000 on the S&P next year?
I mean, look, that's our bull case, but I have a hard time sort of getting to 3,000 unless you really assume an overvaluation, a true melt-up. And I think this is an important point I'm trying to make to our clients, which is, look, I'm on board for what's happening right now. We've been bullish all year on this. I think a lot of it's gotten priced at this point. Could there be an overshoot to 3,000? Yes, but I can't get there on the fundamentals. In other words, the high quality risk reward of this rally was this year. Next year will be more of a garbage time rally, where we can get to 3,000. I just want to make a very clear distinction on that. So, we'll see how it goes, but I don't think this is, I'm not nearly as bullish at the time as I was last year. Your
base case is that we peak in the middle of next year.
That's right.
Why is that?
So, and this is a call we've made for quite a while, and this relates to this week. We've said all along that the day they actually sign the bill is a day you should think about the market topping, okay? So I do think there's a risk for a short-term top in here, but I don't think it's the end of the cycle yet because we still got to get the knock-on effects into the real economy. But think about what they're doing. They're doing a politically motivated tax cut at the end of an economic expansion. That's not good economic policy, okay? And in theory, it's a policy mistake. So it's going to cause overheating in the real economy. It's going to cause the Fed to go faster, not slower. And that's how cycles end, essentially.
Gina at BI, sell the vote?
I totally sympathize with the view, frankly. I hate to not have a different opinion, but I totally think that this week has been a really interesting display of a market completely ignoring the real economic impacts of a tax policy reform.
Right.
Because I totally agree. The reality is the Fed will have to move a little faster. If this is really effective in stimulating economic growth, it will likely create an inflation outcome that is not forecast by anybody in the market right now. And the result is probably faster than expected monetary policy tightening, which inevitably results in an end to the cycle. I mean, that's been the end of every single cycle we've had since 1960 as the Fed inverts the curve because they chase the inflation dragon, right? And they inadvertently invert the curve.
Yep.
And the result is economic recession and earnings recession. And I think that's the risk that nobody's trying to price as a result of tax policy.